So we are now in the fourth week. So we're literally approaching the 50% way of this course, which is quite good. And I'm hoping that a lot of the guys here, you lot have already digested and started picking up on a lot of the information that we've been discussing on the Sunday call, as well as the resources that I've been giving all of you as well. Now, as of next week, I want you all to have your charts open because a lot of what I'm going to be teaching is very important that you actually apply the teaching yourselves. I did send you guys a few things in the group, in the course material group. As far as I'm aware, there's only two people that's actually completed that course material in terms of the chart analysis that I sent. As I said to you guys before, the only way in which you're going to be able to even understand and be able to interpret the markets in the best possible way is actually carrying out the analysis yourself. So 1 day, 1.5 hours is not good enough for you to get to the skill level that I expect all of you lot to be able to put on your own trade. So please, 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 I will remind you once again, just try to make sure you can commit, even if it's 30 minutes a day to doing chart analysis. That's the only way you're going to improve with what we're doing. So today we're going to be focusing on Fibonacci, retracements and extensions, divergence, both regular and hidden divergence, multi-time frame analysis, currency correlations, and mindset. Again, as you guys are should all be aware by now, is that after every lesson, every week that we do, the last part of the lesson will always be focused on mindset because that's the thing that's going to make or break you as a trader. Everything else, I feel like you lot should pick up quite well over a period of time. But the mindset is something that, regardless of you being in the markets, whether it's 10 years, 15 years, you can easily fall to the wayside if you've not put yourself into a good routine and a good way of thinking when you're trading. So let's get started. So the first thing first and foremost, can everybody put your hands up? There's two things that I need you guys that you guys should have done already. One should be your trading view. So this is for all of the new people who's learning how to trade. You should have opened up a trading view account. And if you haven't, you need to open up a trading view account. Two, if you haven't opened up a trading view account, you should have opened up your Vantage account through the link that's been sent. The Vantage account does have trading view embedded within it. So whereas I said to you guys, there's a free subscription and there's a paid for subscription within TradingView itself. The great thing about Vantage is that they have TradingView integrated into their system. I'm going to show you all very quickly, just so you can see what I'm saying. So this is my Vantage trading account. As you can see here, the great thing about it is that all of the analysis in terms of TradingView that you would have um, had access to via TradingView itself, you can also get it through Vantage. But you need to open up your Vantage account in order to get access to these tools. And now, as I've mentioned to you all before, the Vantage is something that you can open up now, whether you're depositing money or not. It's better if you deposit your funds before the 30th, which is in 9 days, because as I've mentioned to you all, once the 30th comes and goes, that 150% deposit match scheme is now going to be over and done with. So, of course, if you open it up and deposit your money before that, even if you're not going to trade till later on, do that. But if you don't do that, in order for you to actually start applying the teachings that I'm giving you, you do need some sort of chart open. Aside from Vantage or Trading View, I know some people also use MetaTrader as well. I don't use MetaTrader. I'm a trader. In my personal opinion, TradingView, the analysis is better for me. I much prefer TradingView in terms of the interface. But again, you guys can open up your TradingView, you can open up your Vantage, you can open up your MetaTrader 5 account, and then you can kind of go with what you prefer best in terms of layout, UI, and etc. So this is a lot of the analysis I'm going to be showing you today will be through the Vantage platform. And again, because they do have TradingView, and I'm going to show you a few more analysis straight from TradingView as well. So Fibonacci, what is Fibonacci? So when we spoke last time, when we spoke last time, a lot of you guys should remember that we discussed support and resistance. So identifying your key areas of support and identifying your key areas of resistance. So a lot of your key areas and supports and resistance we can do manually through kind of looking at where the big trends were and where the big swings came from the trend. So if we had a impulse, as you guys should have an idea of at this moment of time, after every impulse we get a correction. After every correction, we then get it then follows by another impulse. So generally speaking, if you have a trend, you've got two types of people. People do two types of things. So some people, when they look at a trend, an impulse, a correction, they manually put a area of support or resistance. So this would be an area of resistance. And then once it comes back up to that area of resistance, they try to use this as some sort of reference point to understand whether it's going to bounce back from that or go straight through. Of course, I'm teaching you guys to how to be Elliott wave traders. So as an Elliott wave trader, your areas of support and resistance that you might draw manually is not as important as what it would be to other people. Because where some people are looking at, oh, it bounced there, so that should be your resistance, it went back up there, that should be your support. As a Elliott wave trader, you're seeing it as we had an impulse, which means we're due a correction, which means we're due another impulse, meaning we're going to do another higher high, which means even if you've got that area of resistance there, because of the way in which you're trading in terms of Elliott wave, the likelihood of it breaking that area of resistance is extremely likely because you are trading through wave theory, impulse and correction. Now, with Fibonacci, the great thing about Fibonacci is that Fibonacci helps us to identify preset layers of areas of support and resistance. Fibonacci, there's a whole load of kind of background knowledge behind it, which will allow you to understand the reasons for the fib levels that it puts in place. But generally speaking, the fib levels that the Fibonacci tool will put in place, generally the markets do respect those Fibonacci levels. So it's because a lot of people, in terms of hedge funds or the market leaders, market participants, whether you're a retail trader or whether you're a banking organization, generally speaking, because a lot of people tend to respect those levels and trade within those levels, it usually tends to have some sort of impact on the market when a price action goes to any one of those levels. Now, I'm going to share a chart as I always do with you guys, just so we can put everything into practice. So if you want, you can feel free to open up a chart on your side, but if not, then you can just view it straight from my chart, which I'm going to show you all. You guys should all see this chart right now. So this is GBP USD. Now, when you're looking at a fib level, you always want to draw the fib level from the previous swing low to the next swing high in a uptrend. When you're in a downtrend, you always want to draw the fib level from the previous swing high to the previous swing low. So I'll give you an example before we start the trade. So if you're in an uptrend and you've got an impulse, then you have a correction, and you're trying to identify where an area of support or resistance is going to go, where it's going to be, what you want to do when you get your Fibonacci tool, you want to get your Fibonacci, what's called a Fibonacci retracement tool. So with a Fibonacci retracement tool, what the idea of that is for us to understand where is the markets going to retrace to once it does retrace. So as we've had our impulse, we've had our correction, which is also called a retracement. Once we're going in terms of another impulse again, the idea is for us to understand at what point do we believe it's going to retrace, i.e., do another small retracement to then give us another impulse to the upside. So that's the whole point of a fib. So we want to take what's called our Fibonacci retracement because if we're looking at a correction that is created, we are now trying to ask ourselves, well, where is the next area of entry for the correction that we're currently in? So what you would do, you'd go from the previous swing low. So remember, when you're in an uptrend, you're always taking the Fibonacci from the swing low to the swing high. So that is how you will take your Fibonacci tool. The only way you're going to understand whether it's got a swing high is by waiting for the correction. Until it's done a correction, you're not going to be able to identify a swing high. Because of course, if the market's doing this, I mean, you can't identify, it's currently in one wave. You have to have a minimum of two waves to even apply your Fibonacci tool. So the moment you've seen it go from wave one to wave two, then you can put your Fibonacci tool to understand at what point can you go to try and go in for the buy for wave three. If we apply it to the charts, all of this is one wave. So from this point here to this point here, that is one wave that we are all looking at. So now we've identified a wave, and remember the reason why we know that's one wave is, okay, this is another thing I'm going to show you as well. We're also going to get onto what's known as oscillators. So an oscillator that you guys are always going to need to use is the MACD 4C. On trading on Vantage, it's just called MACD. But the MACD allows you to understand how much waves have we got within the markets. So by identifying how much waves we've got, like I said, you can then start placing your Fibonacci tool. When it's in a red wave, when it's in red and it goes from red to green, that means it's gone from a wave down to a wave up. So here was all red, so that's one wave. The moment it goes into green, it means we are now in another wave. So one wave down, one wave up. If it doesn't, let me know. Feel free to literally unmute your mics if something's not making sense. So we're in a red territory, which is one wave. Once we go into green, we're now in another wave. When we go into red again, we're in another wave again. Once we go into green, we are now going into another wave. So if you see this, we've got one red, one green. So that's two waves. We've gone into red again. So that's three waves. So 1, 2, 3. That is how we are able to accurately identify the waves that we are currently in. Don't get me wrong, you guys will be able to identify waves just by looking at it from your visual eye, but it's very important to have additional indicators which will allow you to further identify and get more clarity on the waves that you're looking at. So we are currently in a uptrend. If we're looking from this point here, which is where we're looking at, to where it's currently trading, we are currently in a uptrend. Even though we've got 1, 2, and we're currently in our third wave, we are still on an up. So if we're in an uptrend and we think it's going to continue to go further up, we are going to start using our Fibonacci tool. So with our Fibonacci tool, we're going to take it from our lowest point of our uptrend. So this is the lowest point, and we're then going to take it right to the highest point of our uptrend, which is there. So you're always taking it up to the highest point it's been, which is the wick. So the wick, as I said to you guys last week, even though it's a wick there, that shows you or tells you that at some point throughout the day, it was trading at that point, hence there being a wick. So now we've got our Fibonacci tool. So we've got the lowest point that we've taken it from to the highest point because this is an uptrend. And now we can start to identify at what point, if we believe this is going to continue to go up again, at what point would be a good area for us to buy it of the Fibonacci. So remember, it's a retracement tool. So retracement meaning we're getting a correction. Once we've identified the correction, we then want to go in for more buys. A retracement in Elliott wave terms means a correction. So here we have our fib. So currently, one thing about the Fibonacci tool, it will always present a multitude of different levels. Now, with the different levels that it presents, in theory, they're basically areas of support because we're in an uptrend. It's always going to be an area of support. If we're in a downtrend, it will always be an area of resistance. So if it goes to the 23-point fib, that generally is not that's weaker than the 38 fib. The 38 fib is weaker than the 50 fib. So what I mean by that is that The price is more likely because it's already extended beyond the 23 going down to the 38. The price is more likely to break past the 23 fib again. The moment it gets down to a new level, which in this case would be the 38 fib, that's where it's going to hold more strength at the 38 fib. If it breaks the 38 fib again, then it goes to the 50 fib, then of course that's when it will continue to hold more strength again. So the lower it goes down, the more stronger the area of support will potentially be. Now in trading terms, what all traders say is that the 68 fib is the 618 point fib is genuinely the golden zone. The reason why it's the golden zone is because based on probability, more often than not, once something retraces all the way back down, let's just say this went all the way back down to the 618 point fib, generally speaking, you tend to get a very, very hefty bounce. So it tends to retrace or continues the trend from there. Now, it doesn't always go to that point. Just because this is a key area or what we call the golden zone, doesn't mean that we're anticipating it for it to go to this point. Because a lot, it depends on the correction that you're looking at as well. So remember, like I said to you, with the fib levels, you're comparing it with everything else. So when I'm showing this fib level, the whole point is for you to have another tool in your trading bots that you can use in conjunction with your pattern identification, with your corrective formations, with your waves, with your, what did we discuss last time, with your order blocks. The whole point is that you can bring all of these forms of analysis together. And as you bring all of these forms of analysis together, what that means is that when you are ready to buy or when you are ready to sell, it means that you're picking more accurate areas to trade, to go in for a buy and a sell. And the whole point of us trading and being successful in what we do is making sure that we're accurate with the trades that we put on. Of course, if you're inaccurate and you put on a trade to buy this here and this ends up going all the way down there before it goes back up again, what does that mean? You're probably going to lose in that particular trade, not realizing that you could have had a better entry, which would have increased your probability of of having a winning trade. So it's all about accuracy, and the only way for us to be accurate is to have multiple forms of analysis that we can combine together. And considering it ticks off most of those areas or those areas of references that we have, then we can say we're good to buy or we're good to sell. So if this goes down to this 38 fib, but it goes down really, really impulsively, as a wave theory trader, remember, we said after every impulse comes a correction. So we're probably not going to buy it from there because we've had such a strong move. We're probably going to say, okay, if it's gone there in such a volatile or momentum way, if we're looking for correction, because after every impulse you get a correction, we're saying the likelihood is that it's probably going to go even further down to test the 50 fib. As it continues to go down, we are now going to start drawing our trend lines. As we start drawing our trend lines, what we are now going to say is that based on what price is doing at this point when it gets to this fib, we are either going to have this as an area for us to buy to go all the way back up again, or we're going to wait it out because it could possibly correct again and do another leg down again. So it's very important for you guys to all understand that whilst I'm saying that Fibonacci is a very, very good tool, which it is, we need to make sure we combine it with our other forms of analysis. Now, if it breaks this trend line, so this is GBP USD, so it's done a 1, 2, 3 down, it's done a 1, 2, 3 up, as we can see. Now, what we want to ask ourselves is that if this is a uptrend that we're currently in, we're now asking ourselves, if it breaks this area of reference, this trend line, how is price going to travel down once it breaks that area? Is it going to travel down in a way where it's very corrective? If it is very corrective and we start to have trend lines and then it approaches the 38 fib, can we start to say, once it breaks that trend line, we're probably going to resume our trend back up again, which means we're going to have a 1, 2, 3. Or do we say to ourselves, as I said before, if it goes down impulsively, once we get another correction, we're going to get another down again. So it's also it's very important that we need to watch the way price moves. We need to understand how price moves correctively and how it moves impulsively. Very, very important. So that is a retracement fib. So like I said, that's the uptrend. If you're in a downtrend and you're looking at a retracement fib, so let's identify a downtrend. So this is a downtrend here. It's a bit Actually, let's take it from a smaller degree. So if you guys can see here, this here is our down. So this is what we're going to analyze now. So I'm going to go to the 4 hour time frame. So as you can all see here, this one wave is one downtrend. Of course, once you go into a bigger degree or bigger time frame, you'll understand that this one downtrend is probably part of a bigger uptrend. But for the sake of the trend that we're currently looking at here, we're just going to identify this piece. So when you're in a downtrend, rather than taking a fib from the previous swing low to the swing high, which is what I've done in the uptrend, you now want to take it from the previous swing high to the swing low. So what can you see here? You've got this move to the downside, so that's one wave. You've got a second wave back up. This is the correction. Before any of this happened here, so try to pretend that does not exist. What you want to identify through using the Fibonacci tool with your pattern identification and your trend line analysis is where is going to be a good point for us to sell it to keep going down. So we're taking it from the swing high, the highest point of the swing of the high to the lowest point of the swing low. There you go. So that is our Fibonacci tool there. So as we can see, the Fibonacci broke past the 23 fib, but as you can clearly see, it didn't make it up to the 38 fib. Now, the fact that it didn't make it up to the 38 fib and it broke back into the 23 fib zone gives you some sort of indication that the 23 fib is probably what is going to respect before it continues going back down again. But like I said, we're not just looking at fib levels, we're also looking at trend lines, we're also looking at patterns. So we've got this correction. This is the correction. So this is the structure that we are currently looking at, this correction here. Within this correction, we want to identify our trend line. So how are we going to identify a trend line? So we've got a couple of different trends here. So we might need to actually go down into a smaller time frame to identify our trend. So if we go down to the 1 hour, so we've got our trend line. So what you guys will see as well is that unfortunately some trend lines do look, because of the wicks that come through it, it will confuse you. So a trend line is something, as I said to you guys, you identify where it has a minimum of one higher high, or in the case of a downtrend, it has a minimum of one lower low. So this would be our trend line here. Some people would put another point of reference, or some people do this, something like that, to have another point of reference. But I always try to look at your MACD and go into your smaller time frame to identify where the trend is going to be. So if you've got a 1, 2, 3, 4, 5, and with your MACD, if you go down to a lower time frame, it goes from red, it goes from green to red to green to red to green, meaning this is our green zone, which confirms our uptrend. This is our red zone, which confirms our downtrend. Green zone again, which confirms our uptrend. If you see the MACD correlates with the price action when it does its higher high, then you can confirm that this is an official wave, that's an official wave down, that's an official wave up, that's an official wave down again. So always use your MACD to help you confirm exactly how much waves has happened within that. So we've got our trend line, we've got our Fibonacci tool. We've seen that it's gone into the 23 fib. We've seen that it's not been able to go back to the 38 fib. Prior to even getting there, it's actually broken the trend line. It's fallen back into the 23 fib again. And what we can also see is that as it's fallen back into the 23 fib again, it's retested it. It's tried to retest that point of the 23 fib. And as we can see, the retest there is continue to go down, and go down. Now, as a wave theory trader, a lot of us would have probably got involved here or got involved here at the break of this trend line. So as a trader myself, this is how I would take the trade. So I would have done my swing low to my swing high. I'd have said to myself, okay, it's not coming to contact with the 38 fib. I would have also said to myself that it's broken my trend line. So I would have said to myself, okay, brilliant. If it does go back up once it's broken back out down into the 23 fib again, the likelihood is that it will retrace back off the 23 fib now that it's gone back into that zone. And if anything, I could probably take another sell to the downside because it's fouled, it's not managed to hit the 38 fib. Now, if the price touched the 38 fib and it slightly went above it, and then it came back down again, and then it started correcting outside, I would start to be not worried, but there's a possibility that it could come all the way back up into the 38 fib again, and even go to the 50 fib and give us a bigger correction before it goes back down. That's a possibility. But one very important thing to learn or to understand is that if it's gone into a new area, so this area here is a brand new area of support and resistance. If it's gone into a new area, but it's failed to touch this area of resistance within this zone here, and it's come all the way back down, plus broken a trend line, you've got a higher probability of it not going back up to the area again, it failing, and then continue to the downside. So always look how the price reacts once it goes into a new zone. So that is Fibonacci retracement. Again, you're going to have to do it on your own charts in order for you to become more and more comfortable with what I'm telling you. So what I usually do if I'm in when I'm looking for a long-term trade, I always try to understand what is going on from a long-term perspective. So when I draw my Fibonacci tool, I tend to draw it on the daily, the weekly, the daily, the 12-hour and the 4-hour. I will draw it as well. I will also use my Fibonacci tool on a 15-minute as well and a 1 hour to try to help me in terms of reference points. But I do not place any trades solely based on Fibonacci. Fibonacci, for me, the Fibonacci levels are the zones within Fibonacci. It has to marry up with everything else. So I know some people use Fibonacci exclusively by itself, but I think any of you, if you try to do that, that's a very dangerous territory that you guys are crossing if you try to use it by itself. So that's that. So that is, let me go back to the presentation. Cool. So Fibonacci. So as I said to you, we've got different retracement levels, 23, 38, 50, 61, which is the golden zone, and the 78. Price very rarely goes down to this point. And I do find that, generally speaking, if it goes as far as that point, it usually goes even beyond it to a point where you can now say it's a trend reversal. So the areas that I would advise you guys to look out for are these areas most. And if it does manage to fall even to the 61 fib, as I said to you before, there's a higher possibility that it will bounce or there will be some sort of significant reaction from that point, because all traders know in terms of self-fulfilling prophecy that that is a very strong fib zone and a fib level. So now we're going to go to extension. So retracement fibs, we do it to understand where the correction is and where we can go for a buy if it's an uptrend to continue it, or where we can go in for a sell if it's a downtrend to continue the trend. Extension levels now. Extension levels genuinely helps you to identify your profit taking areas. So if you're in an uptrend, you've got your Fibonacci tool, you've got the correction, it's broken out of that correction and you can see it going back up again. The extension levels, which I'm going to show you, generally identifies all of the zones above that, which helps you to see where the profit taking areas are. So with the Fibonacci extension level, it will give you an area, which this could be a potential profit taking area. And then it will continue to give you other zones where you can potentially take profits as well. I'm going to go right back to the charts because that's what it's all about. But if you're going to use the extension level, this is what you want to use. Within the extension level, remember, if you are trading this, let's just say you've gone in on this correction, you sold it. The whole point is for the Fibonacci extension to help you understand where is my potential area of take profit. Do I take profit here? Do I take profit down here? Or do I take profit down here? That's the whole point of it. But again, you use it in conjunction, in combination with all of your other forms of analysis. So when you do in a downtrend, you want to take it from its previous high. You want to take it to its swing low. Then you want to take it to the highest point of where the correction was formed. So as you guys can see in that correction, that's the wick there. So that's the highest point of that correction. And then what you want to do, you want to extend it to that point there. Now, with the Fibonacci extension, generally speaking, it works very good when you've got a very, very strong trending market. The reason why the price hasn't even gone anywhere near to these points is because, as you guys all know, this whole big structure here is a correction within itself. But if this was actually a trend and a big trend, the likelihood is that it would go down to these areas in terms of profit taking areas. So ideally, what you want in terms of the figures, so the figures that people usually set for their Fibonacci extension, and this is 1.27, 1.4, 1.618, which again is the golden ratio, but that is the golden ratio for take profit. I don't really use Fibonacci extension as much as I use retracement. I use retracement a lot more in terms of Fibonacci. And when it comes to identifying where my profit taking areas are going to be, I tend to try to use reversal formations, divergence, which is what I'm going to tell you guys about, rather than Fibonacci. Because and again, when you guys start to trade, you guys might use Fibonacci extension more than me. There isn't a right or wrong. All I'm here to do is give you the foundation and get you to understand how the tools work and how you can let the tools work in your favor. But you guys might gravitate to one form of analysis more than the other as you continue to enhance your experience, especially when it comes to trading. So, but generally, that is how Fibonacci extension works. It's there for you to identify where are you going to take your profits and what is a good point for you to come out of your trade. And this is all of the levels that you want to put in. And also another thing to remind you guys as well, sometimes when you go into your technical analysis, whether it's TradingView or MetaTrader 5, it might give you wrong fib levels. So try to always make sure the levels that it's giving you is the correct fib levels. And the way to edit your fib levels as well is once you draw your Fibonacci, so let's just say this, for example, you always want to go to your settings tab, go to your coordinates, and you always want to make sure that your Fibonacci levels are in the right place in terms of your Fibonacci extension. Sorry, not coordinates, your style. So this is how you would set your levels here. But I do know sometimes if you've just opened your trading view, it will give you default levels that may not be the best ones. So always make sure you set it up correctly and you've got the correct figures and the numbers there so everything's accurate in terms of you taking your trade. So that's very important for you not to factor in. So again, it's all here for yourselves, but you always want to draw it from the swing low to the swing high in an uptrend and draw it from a swing high to a swing low in a downtrend. That's the way you want. And again, you always want to see clear swings only. So if something looks choppy, don't draw your fib line. You always want to see a clear trend down and a clear trend back up again. And it's only until you see two waves that you identify your fib retracement or extension level. I use divergence a lot. Divergence is a very powerful tool. Divergence is what is going to help you guys to understand whether a trend is going to reverse or whether a correction is coming close to the end, meaning it's about time for you lot to start buying or selling. I use divergence pretty much in literally when it comes to a correction forming and me trying to understand, are we going to get our continuation? I am heavily reliant on divergence. Sometimes divergence doesn't happen. So it's just because of, if you don't see regular divergence, it doesn't mean you shouldn't commit to a trade. But if you do see it, it does increase the level of accuracy and the level of probability for your trade to go into the direction in which you identify. So I'm going to show regular divergence. Once I show that, we're going to go on a quick 3-minute break. This is probably one of the few things, one of the many things that I think you guys need to really be paying very, very close attention to. Always try to look out for divergence. So what is divergence? So basically divergence, as I said, is what helps us to identify if a trend is going to reverse or if a trend is finished and we are now going into a correction. And that is how I've been able to have my edge when it comes to trading. So what is divergence? So when you're using divergence, you are going to use what's called a leading oscillator. So within the leading oscillator, we've got a few different oscillators. So we've got MACD 4C, which is what I advise each of you to use, because the MACD allows you to identify your trend. And whilst I identify your trend, it also allows you to identify divergence. You're also going to use what's called stochastic as well. Stochastic is another indicator which helps you to understand whether a market is overbought or whether a market is oversold. So this is the stochastic here. So generally speaking, when the stochastic is in this territory here, above the 80 zone, it's really overbought. Once it goes below the 20 zone, it means it's oversold. So these are both leading indicators. Now, with the divergence, what we're trying to understand, so when the price is doing a higher high, so let's just say we've got 1, 2, 3 waves here. Within these 3 waves, we've got a high, one high, then we've got another higher high. Yeah, so we can clearly see 1, 2, 3, high, then another higher high. What you can see in the MACD is that it's doing lower highs. So this wave here is lower than this wave here. Let me show you again, just with a horizontal line. So this wave here, as you can see, is higher than this wave here. This is what is called divergence. So divergence is when price is making higher highs, whilst the MACD is making lower highs. So the MACD high, lower high, price high, higher high. Now, what that is showing us is that even though this is making higher highs, there's a very high probability that this trend is now coming to an end, meaning we're going to start going low again. So that is what the MACD is showing you. So generally speaking, if you are in an uptrend, so you've got 1, 2, 3, you've got higher highs and higher lows. With the MACD, you are going to get a 1, 2, 3. You're going to get lower lows and lower highs. When the MACD does that, it means that the trend is going to reverse and you're going to start coming down again. So you also use your MACD to help you to confirm trend reversals. So based on this indicator that I'm seeing, I am predicting the probability of GBP USD now breaking this point and potentially going all the way back down to its previous lows. So I'm seeing a lot more sales potentially coming in. Now, as I said to you, in order for us to confirm that, we need a break. Once we get the break, we kind of want to go in. Sometimes it will retest, and if it retests, we want to see if it keeps coming down. And this divergence makes me feel even more confident in the fact that it's going to break this structure simply because of the divergence. Now, if we didn't have divergence, what that could have possibly meant is that once it goes to this trend line here, we could have potentially got another up if we didn't have the divergence. So divergence is usually very powerful. Now remember, the only way you can confirm divergence is once it goes from one wave to another. If this stayed in the green area and you didn't see these reds, you didn't see these red moves here, and it stayed green, and that was still only one wave, we can't confirm divergence. So with divergence, just like price action, we're showing us a minimum of a 1, 2, 3. With divergence, you need to see a minimum of at least 2 waves before you can even call any sort of divergence. I'm going to show you another chart just to give you another idea of divergence. So this here is the US 30, Dow Jones as well. I'm tracking this trend here. So this is the trend that I'm currently tracking within the US 30. Within the US 30, in order to help me understand if a trend is coming to an end, I am looking for, as I said to you guys, divergence. So whilst the price is continuing to go up, I'm looking for the MACD or the stochastic to continue to go down. The more the MACD goes down whilst this goes up, the more I know this trend is coming to an end. And if this trend is coming to an end, that means at any point we're going to start getting sell-offs. Now, whether the sell-off occurs in terms of a massive impulse down or whether the sell-off occurs in terms of a correction, regardless of what happens, I'm still looking for potential sells. So as you can see here, we've got a high, we've got a high, we've got a lower high, we have another lower high, and then in this last wave here, we have another lower high. So we've got 4 lower highs in the MACD. Now, what's happening with the price? We've got a high, we've got a higher high, and then we've got another higher high, then we've got another higher high after that. So we've got 4 higher highs in the price action, whilst we've got 4 lower highs in the MACD. Now, that I would say is a very, very strong indicator that at some point we are going to start going down. And again, the whole point of that is that it helps us to identify reversals in a trend, or it helps us understand whether a trend is coming to an end and we're now going to start getting a correction. So because of that, I am looking for sells in this trade. I'm not looking for buys, I'm looking for sells. Now, if we didn't get any MACDs, let's just say that was going high, this went higher than the previous one, this went even higher than the previous one, so it was going up like that. That's showing me that this trend is still very strong, meaning there's still a very, very good possibility that we are not stopping for now, that is going to keep going up. So always use MACD stochastic. Again, it shows us pretty much the same thing, and RSI to help you to identify whether a trend is coming to an end. I'll show you another trade that we can take based on the MACD as well. So if you look here, so you've got a MACD, so you've got price, you've got a high, you've got a higher high. What's the MACD done here? It's done a high. Oh. So as you can see, the MACD's done a high, then it's done a lower high. What would you have done here? You'd have had your trend line. That would have been your trend line. This would have been a pattern potentially, so an ascending wedge. So you've identified your pattern, you've identified your trend line. What else would you guys be doing as well? You'll be looking at your wave. You go into the higher time frames, and then you try to ask yourself, how long has this wave been going on for, and what wave am I currently in? So now you know. Now you're thinking, okay, I'm near the end of the wave. I can also identify a potential pattern that I've seen here, and I can also identify divergence. Now that you've done that, what are you going to do? The likelihood is that you're looking to probably go in for sells. So what has happened since it's done the divergence with this descending wedge? What's happened? It's selling. It's gone all the way down. From this point here, 445 500 to this point here, it's falling approximately just over 2,000 points. So you can, and you guys, I'm going to be sending charts for you guys to do your analysis, but you will see over and over and over again. Every time the chart shows us divergence, generally speaking, you do get some sort of reversal or correction. So we've gone through regular divergence, which again, as you guys know, those always signal reversals, whether it's a complete trend reversal or a correction, which a lot of traders also call reversal to some degree, but we call corrections. You want to be looking for regular divergence. Another good additional signal for you lot to understand where the market is going to continue to go. As well as regular divergence, we've also got hidden divergence. So what is the whole point of a hidden divergence? Well, hidden divergence, number one, is a lot more difficult to identify than regular divergence. And number two, it doesn't appear as frequently as regular divergence as well. So when you are looking at hidden divergence, let me share the chart once again. Hidden divergence helps you to confirm a trend strength. So if the price is doing a higher low, so you've got one low, then you've got another higher low. And then the indicator makes a lower low, so you've got a high and then a lower low there. This is what is called hidden divergence. Now, what that means is that at the point in which this correction occurred, the MACD went even more into oversold territory. Now, the fact that it went deeper into a oversold territory indicates that once it does go back up again, it's going to be a very, very strong move to the upside. So basically, what it confirms is that whilst let's just say this is our first wave, this is our second wave. One, two, three. Oh my God. This is our first wave. This is our second wave. Within the MACD here, this is our first wave. This correction here is the second wave. This is the correction, yeah? By saying that this correction went deeper into the oversold territory than this wave here, is basically saying that by the time we break out of that correction, because we're currently in an uptrend, we're going to get, it's basically indicating that we're going to get a lot more momentum going to the upside. So it basically confirms the strength of your trend. That's all it simply does. Now, again, it's something that we use to make us feel more confident in the trend that we're currently trading. And it's something that helps us to understand whether we're actually in a trend or whether it's just a correction. So I personally don't go out of my way to look for hidden divergence. I don't. A lot of the analysis and the way I trade, I look for the wave. So I say to myself, okay, what wave are we currently in? We're in an impulse. And then I say to myself, okay, it's broken this trend that we've got within the impulse. As it's broken, as I'm looking for a end of the impulse, what sort of formation am I looking at? Is it a reversal formation? Yes. I then go back into the smaller time frame and I say, okay, within a smaller time frame, can I see divergence happening within this pattern formation that's creating up here within this one option? Yes. If I can see that, I've got a lot of different forms of reference points and analysis that's giving me the signal that we're going down. So once we go down, and if we go down correctively, and I'm looking for another buy again, my buys are based on what is happening within this correction here. Now, by the time the MACD has shown me the hidden divergence, if I'm being honest, I'm already in the buy. I'm actually in the buy before it's shown it. And that's simply because I'm always doing my cross time frame referencing and I'm always looking for what is happening within the wave count, within the correction, before we even get to a point where the MACD is showing us hidden divergence. That's not going to be your reason for taking a trade. It's just going to give you an extra layer of confidence for the trade that you will be in. So, as I mentioned, I use the MACD 4C, which is on TradingView. If you are on MT5, you'll probably, I'm not sure if they've got 4C, it will probably just be MACD. I also use the stochastics as well. The stochastics helps me to understand whether something is overbought territory or oversold territory. And it also helps me to understand where the divergence is as well. But I did used to use RSI, but because I'm already using Macri and Stochastic, for myself personally, I don't personally use the RSI. What you guys will start to see is that a lot of traders do use RSI, and it's perfectly fine to use RSI. But I wouldn't suggest for you to have all three of them on at once. It's just going to overcomplicate things. Try to have a maximum of two leading oscillators, and then from there, you combine it with your trend line, pattern identification, wave count, and your Fibonacci, and then you should be fine from there. Now, I've spoken to you guys about this a few times. You've seen that every time I do my pattern identification, every time I try to understand what sort of time frames are we looking at, all of these things helps me to get a big perspective or a big understanding of in regards to exactly what trend are we in? Are we going up or are we going down? Now, how I do my time frame analysis, I always start with the biggest time frames first. So I always start with my weeklies, and then for my weeklies, I look at the overall structure. So what is the structure telling me overall? What sort of trend are we in, and have we been in over the last few years, over last few months? Once I identify where we are weekly, and I then go into my daily also helps me to understand the big trends that we're currently in, or the big areas of support and resistance in terms of retracements, mainly mature retracements for the Fibonacci. Now, once I understand that, I then scale down into my 4 hour and my 1 hour time frames. So all of that, when I'm scaling down, I'm pretty much doing the exact same thing. So I'm understanding, okay, so when I've done my weekly and my daily time frame analysis, by the time I've gone into my 4 hour, in the back of my mind, I know, for example, that we're in a massive uptrend. So when I've gone down to my 4 hour, even if we are in a downtrend in our 4 hour or 1 hour analysis, I know that downtrend is is going to be short-lived. It's not so meaning if I'm selling it based on the 4 hourly time frame or the 1 hourly time frame, at some point I can expect that we're going to go back up again. And I will tell you this as well. A lot of times traders, and I used to do it myself, and I lost quite a lot of money doing this myself as well. They will look at their hour or their 4 hour and they will say, okay, we're clearly in a downtrend. They will go into a trade based off the 1 hour and 4 hour. They will sell it. They will say, this looks promising, and let me stay in the trade, not realizing that because they haven't looked into their daily time frame, they overlooked the fact that they were actually in a huge uptrend. So what you'll realize is that at some points, something may be looking like it's going down, and it may actually have a lot of momentum as it's going down as well. At some moment of time, you might get a huge order block going in the opposite direction, which is a buy. You might think to yourself, that's weird. Why have I got a buy all of a sudden? But what you didn't realize is that if you looked into a bigger time frame, you would have probably saw that buy coming. That buy was just a entry for the traders or the large institutions looking to resume the uptrend that they've been in over the last 2 to 3 to 4 to 5 years. So always look and try to understand what is going on from a long-term perspective before you start identifying trades based off your hourly and your 4 hour. So when you do identify it, you know that it's not something you're going to be in for a long period of time. If I know there's an uptrend and we're in a downtrend on a 4 hour, I generally speaking, me personally, I try to go into the same direction of the trend. Like I said to you, the trend is your friend. I'm going to share my chart now. And as I go into the same direction of the trend, what that usually means is that I've got a bigger probability of the trade going in my direction. And that's the whole point of you guys when you're trading. You want to make sure that wherever you trade, that you're following where the bigger probability is, like where it lies. So this is the US 30. So as I said, we are in a big trend on the US 30. So if we go on a weekly time frame, the US 30, all the way from this moment here, so back in 2000, 2000s actually, has been going up literally over the last 25 years. As you can see, every single time it's had a downtrend or correction, it's gone back up again. It's had a correction, it's gone back up again. So already I know that we're in a massive uptrend. Now, when I go into my daily, I'm looking at this current trend here as well. So from April 2025, I can see we've been in a quite a big uptrend for the last 5 months. So if I'm going to sell it, I'm probably selling it with the understanding that it's probably going to be a correction for us to go back up again. More than likely. The only time it will be a complete reversal, generally speaking, as I said to you in the second session that we had, is if we've had some macroeconomic news or some fundamental news that's really indicated that the world is going tits up and everything, and whether it's war or tariffs, anything or interest rates, that we are now going to start going down. But as long as the from the worldly perspective, the fund everything is pretty stable and the trend looks like it's in a certain direction, I will genuinely try to trade in the same direction of the trend. And if I am going to sell it, like I said to you guys, I will be looking for a sell for this. My sales more than likely are going to be short-term sales. When I say short-term, I mean I'll probably be doing intraday trades over the period of, the next few days, the next few hours. And if I know if those intraday trades are now going into weeks, in the back of my mind, because the weekly trend is a up, I'm now thinking to myself, at some point of time, we are probably going to resume our trend back to the upside again. So it literally allows us to really have such a huge, clear understanding of what is happening from a smaller perspective into the bigger perspective. And that's how I would always advise each and every one of you to trade. Always make sure you're starting from the upside, and then from the upside, you're working your way down into the 15 minutes. And this is multi-time frame analysis. You always want to go from that perspective. When I go into my 15-minute and my 5-minute time frames, that is literally just to help me to enter the trade. That's my entry point. I do not use a 5-minute time frame or 15-minute time frame to identify trends. I use it for an entry. My trend is identified on a 1 hour minimum, and then with a 15-minute, then yep, this is my point of entry. This is the trend line that is broken on the 15-minute time frame. I know where it's going on a 4 hour. Let me buy it because I know that's going to be it's going to be cohesive to what is happening on a bigger degree. So the rule, trade with the higher time frame in mind. Don't counter trend just because the lower time frame looks tempting. Always make sure that you're trading in the same direction of the bigger trend. The trend is always going to be your friend. And if it does reverse on a big trend line, you're probably going to know about that before it even happens. Because something from a macro perspective is probably going to be getting released on the news, which is going to help you to understand, okay, we are going down. When the trend reversed for US 30 or Germany 30, it's because of COVID. When it reversed again, probably about 6 years, I think it was 5, 6 years prior to that, is because of the war that was going on in with US and Iraq or Iran. There's always going to be some huge fundamental news that's going to warrant a trend reversing. So you don't need to worry about missing it. Trust me, you will always be in touch with what's going on. So this is the market correlation. So I'm not going to go deep into this. This is just use this page as a cheat sheet, basically. So this page allows you to really understand kind of how you can correlate your certain forex pairs with commodities or certain indices with fundamentals or forex as well. So we kind of touched on this a couple of weeks ago, but again, the whole point is to make sure you've got all of these resources here so you can refer back to them whenever you do go into a trade, or whether you're kind of confused with something, you've got it there. So when the USD is strong, it means the gold is weak, generally speaking. Generally speaking, when the USD is weak, the gold is strong. When the oil is strong, the CAD is strong. because the CAD, has a lot of especially from a dealings perspective, they're heavily involved in the oil trade. And when the oil is down, the CAD is down. Gold, the Aussie dollar is heavily influenced and impacted by gold. So when the gold is up, the Aussie D is up. Also, of course, if gold is looking strong and you look at your AUD USD chart, generally speaking, the probability dictates is that you're probably going to be in an uptrend for the AUD USD. If the gold is weak, then generally speaking, you're probably going to be in a downtrend for the AUD USD. And in terms of stocks, this is quite interesting here as well. So when stocks is up, the Aussie dollar tends to be up as well as the NZD. And then when the stocks is down, the Japanese yen tends to be up, and the dollar tends to be up as well as the gold. So if let's just say US 30 is selling off or Germany 30, and you don't really know what's going on too much you're a bit confused with, let's just say JPY GBP or JPY USD. What that would really mean to you is that, okay, there's probably going to be a higher possibility or potential of the yen strengthening against the dollar or against the pound or against the euro, especially if the stocks are down. And again, we went over this before. US dollar index. If the US dollar index is up, is strong, the dollar's weak, and if the DAX is weak, the dollar is strong. So it's just a cheat sheet. Just refer back to it whenever you can, and try to make sure you are correlating your charts when you're doing your analysis, so you're not too confused whenever you've identified a trend or correction. So the last thing that we are going to discuss again is basically making sure that you can trust your analysis and making sure that once you've identified your divergence, once you've got a correction that's kind of come in line with a 23 fib or a 38 fib, once you've seen that it's broken out of the trend and you can see a correction stating that it's going to continue to the upside, you're basically, you need to trust that the signals have presented itself for a reason. So I might as well just take it. And it's that simple. Don't overcomplicate things. Sometimes we identify things and we second guess, we're like, but what if it doesn't? What if it doesn't? And then before we know it, we miss a trade. If you see, if literally out of your 5 tick boxes, at least 3 to 4 of those tick boxes have been ticked and it's all correlating and it's congruent with each other, then take the trade. Make sure that you've got the right stop, you've got the right risk, and then let it do what it's got to do. The analysis that I'm teaching you, generally speaking, it's got an 8 out of 10 hit ratio, meaning for every 8 trades you take, you're only going to get 2 wrong out of every 10. So out of every 10 trades you take, you're only going to get 2 wrong and you're going to get 8 right. Meaning, if you have the correct risk to reward and you're trading properly and you're not trying to risk 10% of your account or go against your analysis and you're applying all of the things I'm teaching you, you're always going to be up by the end of the year, regardless of how much losing trades you have. Why? Because out of every 10 trades you take, you're always going to, generally speaking, with the back testing I've done, and the length of time I've been trading over the last 10 to 15 years, this does have a very high hit ratio of 8 to 10, which is very, very good. So trust your prep. So once your setup's there and you've planned it, you've prepped yourself, commit, don't freeze, don't procrastinate, don't hesitate. Do not second guess. Because the moment you second guess yourself and the moment you hesitate, you're going to miss your entry. And when you miss your entry, you're going to start chasing losses. And by the time you get in at 50 points higher or 100 points higher or lower, you're now exposing yourself to a lot more risks within the market. And the markets know let me tell you, market psychology, this is, and please take, if there's anything you can take away, please take away this as well. At the beginning of the week, because of the way in which people work and the human brains work, the markets tend to present the best opportunities at the beginning of the week. Why? Because people are just starting to prep to come into the markets. Now, whilst people are prepping to come into the markets, they are also aware that the markets can do whatever it wants to do. Now, because people are aware of that, psychologically, they second guess themselves when they see what may look like a great opportunity on a Monday or Tuesday. By the time they second guess themselves, what the market does, it will present a very similar setup in the middle of the week. And then what the person will do, I'm telling you, I've been in the market for so long. This is what the market does, and it's literally trickery. It's amazing the way it does it. By the time you take the trade on a Wednesday, because you said to yourself, when I wanted to take it on a Monday and I was too scared and I missed that opportunity, I'm seeing it again on a Wednesday. I'm definitely going to go for it. Let me tell you what the market does. It breaks it, you will take it. It will deliberately go in the opposite direction, maybe even take you out, get you second guessing and doubting yourself and expose you to a very high level of risk. And then once it takes everybody out, it then resumes its trend and does what it's got to do later on in the day or later on in the week. Now, because there's so much people coming into the markets, whenever it done that or it played trickery with people, it would do it over a period of hours. But what you guys are going to find is that when it plays trickery with you, it will actually prolong it for a matter of days. It will literally keep you in a trade for days in negative and make you think to yourself, okay, this is a bad trade, this is a bad trade, this is a bad trade. And then by the time you've come out of that trade and you've looked back on it again, literally maybe a day later, you've seen that it's done exactly what you wanted it to do or what you believed it was going to do. So why am I telling you this? The moment you see an opportunity, once you've done your analysis, you've done your prepping on a Sunday, and you've seen it present itself on a Monday, take it. Don't procrastinate. To some degree, we need to be robotic because it's when we're too emotional or we overthink things or overcomplicate things, is when the markets go against us. And it's normal human behavior. So try to think like the minority rather than engaging and interacting with the markets like how the majority do it. And the only way you're going to do that is by committing to something as soon as you see it. So third point, imperfection is normal. So not every trade needs perfect confluence. So as I said to you guys again, so when you've got a technical setups that you've established, that you've identified, in terms of a short-term trade, if 4 out of 5 of your boxes are ticked, go for it. You don't need to wait for 5 out of 5 boxes to be ticked. The markets work in probability. So if the probability, if let's just say you've identified 4 points in terms of your trend line, your pattern, your correction, your divergence, your Fibonacci, your stochastic, but only your divergence, your trend line, and your pattern identification is pointing in that direction, take it. Just minimize your risk if you are going to take it. The markets is never going to, it's very rare that it's going to present you with a perfect setup. So bear that in mind. And just accept the risk as well. So once you place it, don't get emotional, just go with it. You've placed it, that's it. You've got your stop loss there. Just make sure you commit yourself to the trade and do journaling. One of the people in the group put a message literally a couple of hours before this session in regards to the journaling that he's been doing and that I would also advise all of you lot to do as well. There was one point where I slacked off with my journaling and that really did have a bad effect on my trading. And the thing about journaling is that what happens is that when you are reviewing your past trades and you're seeing what caused your trades to fail or what caused your trades to succeed, you are subconsciously planting seeds in your mind about what you should do correctly and what you should stop doing that's kind of affecting your trading. So by journaling, like you don't need to, I mean, I would advise you guys, it's important to journal every day, especially when you're starting. But if you're not journaling every day, try to at least journal once a week, absolute minimum. And when I say journal once a week, all I mean is if you've gone into 10 trades, you've looked at your trading history, write down your trades that went wrong. Ask yourself the question, why did this go wrong? What did I do? How did I go against my analysis? Question yourself. Make sure you're being critical about the choices that you made. By doing that, that then puts you in a position of more insight and more discipline because you now know and understand all of the times in which you went wrong. And of course, because you don't want to do it again, you're going to make sure you're going to approach things differently by the following week you start trading. So definitely try to journal. And again, the last thing is having an edge. So your edge is your consistency. So just making sure that what I'm teaching you, what you're taking away, that you are repeating it week in, week out, day in, week out. And as long as the repetition's there, you've established your routine, then you will be successful. So trading is not about flipping quick money over a period of 6 months. It's about making sure that you're building and you're chipping away at the markets every day, every week, and you're doing it over a period of years and you're compounding. As you continue to compound and go from that perspective, or reframe your mind to think from a long-term standpoint, in the sense where you're chipping away, building, 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 you're laying the blocks, like as people will build a house, then that will help you to be a lot more patient when it comes to trading, and it will allow you to have a lot more grace on yourself if you do lose a trade, because you do know that you're in it for the long run, you're not in it for the short run. So that concludes our lesson for today. As I said to you guys, it would be quite concise and quite simple. Well, I do hope it has been simple and it's been clear for you guys today. That is it.